Greetings. Once again, we're here to continue with our topic which we started, and in the previous video we looked at life insurance, what life insurance really is, and by the end of that video we had agreed that actually in the next video we're going to look at the risks. How do companies handle these risks that are mainly covered or given as a benefit for someone saving them? These risks, we said there are three of them, and these include death, permanent disability, and critical illnesses. And actually, in response to these risks, in case any of them happens, the company provides 100% of the sum assured of the client to the sum of the sum assured to the client or his family in case of death. So, meaning in case of death, permanent disability, or critical illness, the company is supposed to provide 100% of their sum assured. Now, you may not know what sum assured is, but sum assured is that amount of money the company assures of the client in case of occurrence of any of those risks. And that amount is determined in two ways. One, the client may come to start saving with us and they say, I want to save 100 million by the end of 10 years. So that one, the 100 million, or the money they want to save becomes their sum assured. Or in case they don't have any goal, like money goal, but they say I want to save this amount of, let's say 1 million for 10 years. So in case of 1 million on a monthly basis for 10 years, still their sum assured may be 100 million. Is around 100 million, but not less than that actually. So implying in such a case, or in such a sum assured case, in case the client dies, 100% of 100 million, which is their sum assured, which is actually 100 million, is provided to their families or to them in case it is not death that has occurred. So implying that actually you see that in such a case, or in cases of occurrence of risks, the company itself is at a loss, because it is paying out large amounts of money, because this risk not dependent of when it happens or for how long the client had saved. This money is provided. Even if the risk happens after 1 month when he had started saving, that money is provided. The company assures the client of that money anytime after signing the proposal, the contract of the saving plan. So that money is available. So you find that in case of occurrence, the company is at a loss. But even when it is at a loss, it is supposed and it is its responsibility to pay that money. And the company is always ready to pay it, because actually even before they give you an opportunity to save with them, they first determine how highly, or they first determine the level of risk they are taking by allowing you to save with them. How do they come up to this? Now, before you actually, as you're filling the proposal forms, before you start saving an insurance company, the questions on that form are intended to reflect how risky you are. If the client is highly risky, the client may not be given an opportunity to save with the company. And actually that lets you to know that not every person that applies to save with an insurance company is actually given the opportunity to. No. It is after taking a look and consideration of how risky the person is that they're actually given a chance to save with the company. And actually that's where the principle of insurance, that of utmost good faith, that's where it comes in play. That the client is supposed to provide facts about themselves as they are filling that form. And in case they lie and the company learns it on the occurrence of the risk, the company will not compensate the client, because the client would have abused that principle of insurance. So that's how so by the time the company decides to give you an opportunity to save with them, they are actually prepared and ready to handle any risk that comes along the way. So that one gives you confidence that they will actually handle the risk, even if we see that it is like a loss, but that is the function of insurance, and it is a normal case to the insurance companies, so we don't need to worry over that. So it is in this case actually that this policy is of most use to the client, because most cases it is in such times that we need help most, in times of such risks. For example, if you look at the risk of death, In this case, the client does not suffer because for him is dead, but his family is the one to suffer. Now you take actually this one applies to both poor and rich. You may think that the rich are safe, but we see cases whereby the father dies and the relatives take on his properties, they take on his riches, and the wife ends up taking nothing, meaning she's going to suffer with the kids. But in the case whereby the person had such a saving plan and he had put in his wife as the beneficiary, you find that in case of like you've taken the sum assured to be 100 million for this instance, now this 100 million is given to the wife, the whole of it. So this is actually a good amount of money to help her start up something, so to see that the kids do not suffer. And that would be the wish of every parent, every father, every mother, that their families don't suffer in case they have died. So that is one way in which this policy is helpful. And then the other case, let's say case of critical illnesses, whereby normally people are diagnosed with critical illnesses, and in order to come up with the money to help them, they have to solicit money from their families. But take a case whereby someone had such a saving plan, the company comes to their immediate help. And in most cases, with the critical illnesses, the earlier someone gets medical attention, the higher their chances of healing from the disease actually. So meaning such a plan enables someone to, they are like you're at an advantage even in case that risk happens, though we don't pray for such cases to happen. So from that we conclude, actually personally come to conclusion, but these life policies are actually a necessity. They are a life necessity to each and everybody, because these risks are part of life. We live with them. We cannot, like, you cannot run away from them. They are part of life. And actually taking on such a plan is one way of preparing for their occurrence earlier on, because most of these times these risks find us unprepared because they are uncertain. So taking on such a plan is a better way of having yourself prepared for such cases. So you may ask yourself, in case the risk does not happen, do I stand the chance of, do I stand, do I just, does the client just lose it like that? No, does not just lose it like that, because at the end of the saving period, their money is there, it is provided, and then they also have a peace of mind that they are actually, in case any risk happens, they are safe, they are not affected that much. And then those are the minor ones. Then the other way that it benefits is that by saving with us, we give them a profit. We give our clients a profit for saving with us, and actually it is a good profit. The next video we shall look at how companies come up with that profit, and we shall see why that profit, because you realize that actually it is a higher profit compared to most of the institutions, and our way of coming up with that profit is actually different and amazing. So just stay tuned. Yeah, that video will be uploaded soon. Where we'll be looking at how the companies come up or calculate the client's profit and why. Just stay tuned. If you have not subscribed to our YouTube channel, just do for more financial content. Otherwise, be blessed. Nice time. See you soon. Love you all.